The first paper is Risk Return and Environmental and Social Ratings. And the speaker that we have is Professor Kim. His first name is John for us English speakers. And I invite him to start the presentation. The discussant is Arvind Chari. Arvind, you have the responsibility to make sure that at the 5-minute point, he's got 15 minutes, and at perhaps the 5-minute point or the 2-minute point, it'll be useful to just remind him that his time's up.
Can everybody see my screen?
Yes.
Okay, so shall I start or? Okay.
You have the advantage of time.
Pardon?
You have the advantage of time. Go for it.
Okay, thank you. Okay, so thank you so much for having this paper on the program. I'm very excited to present it. This is a joint work with Sudheer Chava, a local colleague at Georgia Tech, and with Jaemin, who is a PhD student at Emory. So I want to begin by emphasizing that investors care about sustainability. By now, there's a lot of evidence, but one obvious piece of fact is that global assets that consider environmental, social, and governance, basically the ESG factors, in the process of investment decision making, have grown from about 23 trillion US dollars in 2016 to about 35 trillion US dollars in 2020. So this is a very rapid growth of about 50% over the span of about less than 5 years. And precisely because of these kinds of trends, what happened last year was there was a recent amendment to what's known as the Employee Retirement Income Security Act, ERISA, and this happened under the Trump administration. And this basically began requiring that plan fiduciaries need to select their investments based solely on investment risk and return. So the main idea here was that incorporating ESG is a bad thing. But the funny thing is, this year, this amendment is being amended yet again under the Biden administration, where they're explicitly permitting plan fiduciaries to consider ESG factors when financial material. And the idea this time is that incorporating ESG is a good thing to do. For our purpose, what we want to learn from this is that this policy uncertainty is manifesting this still significant lack of consensus over the financial cost or the benefit of incorporating ESG factors into investment decisions. So this paper has, as a simple goal, we want to revisit the relationship between risk return and ES ratings, and we're fitting into a sizable literature on this topic, but our novel focus is going to be on that of systematic downside risk. So let me begin by telling you why ESG investing could be bad or good. So we know that ESG investing could be costly if investors who derive non-pecuniary benefits, so basically benefits unrelated to risk return, are the marginal investors or those that derive equilibrium asset prices. But on the other hand, Benegu and Tirole in 2010 paper make the argument that profitability of a firm does not necessarily have to go against doing good or being ethical. And they specifically write that corporate social responsibility is really about taking a long-term perspective to maximizing intertemporal profits. So generally put, this suggests that doing good could be associated with better financial performance, but we take this idea to imply something more specific, that high CSR firms will have lower systematic downside risk. So for example, this is, I think, a very typical story of the benefit of ESG you would hear. A firm might think about economizing on safety or pollution control. And to the extent that the firm is able to economize on these costs in the short run, this would obviously lead to increased profits. But at the same time, this could expose the firm to contingent liabilities down the road. So for example, there could come about some risk of new regulations that require the firm to completely overhaul its production processes. It might face some environmental accidents, which is going to require significant cleanup costs. So we hypothesized that these types of risks would be systematic to the extent that many firms suffer from managerial myopia. But of course, when many firms are suffering, high CSR firms, in this particular example, the environmentally friendly ones, might perform better. And as a result, we hypothesized that high CSR firms might have lower systematic risk during market declines or lower systematic downside risk. So this is an empirical paper where we try to empirically analyze the implications of a firm's ES ratings on, first of all, future stock returns, the unconditional average returns. We don't find much of a meaningful relationship. We believe this is consistent with various mixed results for the ES ratings and the stock returns in the literature. Then we go on to look at the future exposure to unconditional risk. We do find that high ES firms have lower systematic market risk, but this effect is statistically insignificant once we account for the fact that market beta is highly autocorrelated. Then we go beyond the standard unconditional risk and return framework to focus on the systematic downside risk. And here we do find that firms with high ES ratings have statistically significantly lower downside risk than those with low ES ratings. Now, of course, it's always important to account for the economic magnitude of this effect. We're going to argue that such reductions of downside risk are going to deliver for us gain that is relatively smaller than what the previous literature has found. So it's modest, but still we believe it's non-trivial. It leads to a gain of about 1% per year in terms of the long run compounded return. I'm not going to have time to discuss these results, but we did try to look at how ES ratings are related to realized firm news sentiment and with institutional trading patterns. And all I'm going to say is that we seem to find results that seem to be very similar to what we find when we use the stock returns data. So in the interest of time, let me skip the literature review. I'd be very happy to talk about it if anybody's interested afterwards. So two key variables we need to define is the ESG and the downside risk. For ESG measures, we're going to use the standard MSCI ESG KLD stats database. So some of you might be aware that MSCI KLD classifies ESG performance into 13 granular categories: environment for E, community to product, the 6 categories represent the social, alcohol to tobacco represent the sinful industry. So these are industry fixed effects essentially. And then corporate governance for the G. Following the prior literature, we're going to focus on the first 6, and that's exactly why we say ES ratings to focus on the environment and the social components. We don't look at the industry effects because we're going to be controlling for the industry fixed effects, so that we're looking at the implications of ES performance within a given industry. And for each of the 6 categories we consider, KLD compiles information on both strengths and concerns. We're going to construct a net ES measure that's going to add strength and subtract concerns, such that this measure is going to range from -1 to +1. Adding across the 6 categories that we consider, we come up with our main proxy for the net ES performance, which is a measure that ranges between -6 and +6. To compute the downside beta, let me start with the usual systematic market risk. So at each point of time t, we're going to use daily return data going forward for the next 12 months. So it's about 250 points of data points. And we're going to ask, how does the stock return co-move with the market? That's the usual unconditional market risk or market beta. Within the 12-month period, we're going to pick 6 months during which the market has done relatively poorly. And during those 6 months, we're going to again ask, how does the stock co-move with the market? That's going to give us the measure of raw downside beta. So those are the 2 betas represented in the equation here. The problem with the raw downside beta is that if you were to look at how the correlation between the unconditional market risk and the systematic downside risk, these 2 measures tend to be very highly correlated in the cross-section. In our database, I think the correlation is around 0.86. So Ang, Chen, and Sheng in their 2006 paper make the argument that it's important to look at variations in downside risk above and beyond the variations that occur due to systematic market risk. And they propose a measure called relative downside beta, which is simply the downside beta minus the market beta. So this is going to be one of our key measures in the paper. We also look at the Coskewness and tail risk beta. I'm not going to get into much details in the interest of times, but both of these have been proposed as alternative measures of how the stock co-moves with the market when the market is typically doing bad. So let me. The last thing that I want to get across is that we focus on what we consider to be big firms, because the main benefit of using KLD database compared to other competing ESG data analytics provider is that it has a longer history, and we want to take advantage of this longer history. But what happens is, if you were to look at typical size of the firms that are rated by the KLD database in the early years in the 1990s, it tends to be noticeably bigger. So when you look at firms with relatively smaller market caps, they tend to be fewer. And once they start to go beyond S&P 500 and start looking at Wilshire, you see that around 2003, the coverage of smaller firms tend to explode substantially more. So in order to make sure that, because we're going to be working with mostly Fallman-Macbeth regressions, to make sure that we're averaging across similar or comparable cross sections, for the main data analysis, we're going to be focusing on firms with the market cap bigger than the median New York Stock Exchange size breakpoint. But in the paper, we also consider as an alternative database of the universe of all the firms starting from 2003 as an alternative database. So first of all, what we do is we don't want to rule out the possibility unconditional risk or return could explain the patterns of ESG investing. So what we do is we first of all look at the beginning of each month T, we're going to sort firms into 5 quintiles based on their past ES scores within a given industry. And then we're going to look at what happens to the monthly stock return. At the same time, so let me begin by talking about. So doesn't really matter whether we look at equal weighted or value weighted portfolio. Doesn't really matter what kind of risk adjustment we do. We also try Fallman-Macbeth 5-factor model and various other factor models that we've been asked to try. Generally, what you find is not only is the difference between high ES portfolio and low ES portfolio, the differences are not significant, the signs flip, and generally they tend to be very small in magnitude. On the other hand, if you were to look at the market beta, you find that the high ES portfolios tend to have statistically significantly lower market beta over the next 12 months. So this is something we'll come back to. We
Kim,
repeat the
last 5
analysis
minutes.
with the downside risk measures that we proposed, and we find consistent evidence that high ES portfolio tend to have a low downside risk based on all the 4 measures that we consider in the paper. Just want to note that with Coskewness, high Coskewness tends to correspond to low downside risk, so everything is consistent with what we find based on other measures. Now, of course, the results thus far seem to suggest that it is fruitful to look at the systematic risk implications of ES scores, but this is only controlling for industry. So in order to control for various other firm characteristics that might be potentially explaining what we find, we start running the Fallman-Macbeth regressions, where we're going to be regressing future realized regular beta and downside risk measures over the next 12 months on the past ES score, the industry fixed effects, and to account for the autocorrelation and the risk measures, we're also going to control for estimated risk measures in the past 12 months, as well as various firm characteristics. These are just the usual characteristics like market cap, book to market, momentum. So first thing that we find is that the first 2 columns only control for the size of the firm as well as the past values of the risk measures, whereas the last 2 columns control for everything that we listed out in the previous slide. In both cases, the relation between ES score and beta is statistically insignificant, whereas if you look at the correlation, the coefficient on ES score for downside beta, they continue to be statistically significantly negative. We repeat the analysis using the 3 main measures of downside risk that we've outlined. And again, everything seems to be statistically significant and pointing towards the fact that ES score has a very robust, risk downside risk reduction effects. And again, just remember that with Coskewness, the positive sign is in fact the correct one. So now what we wanted to do was we seem to find that high ES stocks have statistically significantly lower downside risk. Is the economic magnitude big? What we try to do is imagine a firm in the lowest 10% in terms of ES score and move it up into the top 10%. This corresponds to intradecimal range move in terms of ES score, or about an increase of a score of 1.05 point. So we multiply 1.05 to the coefficient estimates that we get. And generally, what we tend to find is that these coefficients are very small. But what's important is the economic effects of the reduction effects that we're finding could be much bigger than the Fama-Macbeth average effect that we've documented thus far. And this could happen precisely when the relation between ES score and downside risk, this might be covariating in such a way that it's more beneficial than simply focusing on the average value. So specifically, what I'm saying is, if it is the case that the resilience of high ES stocks during the worst part of the year is stronger when the year itself is bad, then focusing on simply the average coefficient, average Macbeth coefficient, as we've done so far, might be understating the benefit that accrues from this effect. So Macbeth regression
Kim,
cannot
if I
help us
can
with this, so we
interrupt,
run.
last 2 minutes for you.
Yes, thank you. Macbeth regression doesn't help us answer this. So we run a panel regression that's very analogous to the Macbeth regression. The only difference is now we can condition on whether a given year was a good year for the market or a bad year for the market. So whether the market return was positive throughout the whole year or negative throughout the whole year. And we do find that ES score has a much stronger effect on the systematic downside risk when the market return during a given year was bad itself. So I'm not going to have enough time to go into much details about this, but basically what we argue is the correct way to really account for the effects of the downside risk is to look at a compounded return over the next 1 year corresponding to the yearly time period that we look for measuring the downside risk. And once we do that, these estimates seem to suggest that increase from the lowest 10% to the highest 10% in terms of ES score, that's going to lead to an increase in annual compounded return of about 0.96%. So let me conclude. We don't find any evidence that stocks of firms with high ES ratings differ from comparable stocks based on standard unconditional risk or average returns. But we do find significant evidence if we were to look at systematic downside risk. And we believe that this leads to small but non-trivial gain in future annual returns of around 1%. So let me wrap this up here. I very much look forward to the discussion. Thank you very much.
Thank you very much. Thanks, Susan, for getting me to discuss this paper. I don't know about the prize, but I'm at least dressed appropriately to get the prize. Sudheer, Kim, and Lee, thanks for the very good paper. I really enjoyed reading this. As I understood, the motive of the paper is three: that there is a increase in the assets under ESG methodology. They are trying to figure out whether ESG investing, can it be based on your traditional risk return characteristics, and they give evidence of whether following an ESG investing, is it costly or is it beneficial. And of course this is a very growing thing, right, where as he talked about the ERISA law, where pensions are fiduciary investors, they are obligated to their subscribers, and their objective is to earn the appropriate return. But there's also a growing field of that you have to care about the environment. There is a social and diversity and governance, and so I think it's an evolving field, and I think this paper will go a long way in setting some things right. This is a summary of what I thought the paper found. There's no meaningful relationship between what they use as the ES, environment and social score, and stock returns. Insignificant relation between ES scores and market beta. Kim, you can correct me if I'm wrong in any of these. These firms which have high ES scores have lower downside risk as compared to low ES firms. This is very, very important. High ES scores firms have lower market betas in the future as you forecast. And following ESG as a strategy, as a means of risk return, can add non-financial benefits to investors. These are my doubts and questions. I don't know how you're going to take it. I'll read it out and then maybe we can discuss together. What we believe, and at Quantum we've been doing for since 25 years, is governance is the most important aspect of company performance, stock returns, and risk return. Right? And there is a standard assumption that if a company has good governance, they will have good and they will follow good environment policies. They will have better social diversity, gender, take care of stakeholders. And so governance is the main thing. In their paper, they've taken out the aspect of governance, but they've shown why the governance factor does not matter. I think that's what I got the sense from the panel B of table 5. But my question to Kim is, if you would have included the G score and your -6 plus 6 goes to -7 plus 7, would it have had an impact on the returns and the entire downside risk and Coskewness? So if you have an answer for that. ESG scoring is evolving, right? In India, we still are, in very early stages of having a very robust ESG score. Globally also, the mechanisms, the methodologies, the disclosure standards by companies, right? That is changing. Regulators are now getting into telling corporate that this is a proper format. Stuff like TCFD is coming about to say that, okay, this is the format you have to report. So it's evolving. I have a question on, I know you have a very long data series, but have you run this series on newer scores of the MSCI KLD database? And has it had any impact on your performance? Maybe it's a short period of time, but given that ratings are evolving so rapidly, and there are a lot of questions about ratings also, right? So if you have any answer on that. If you look at the traditional 3-factor, 4-factor, investing approach, if you look at stuff like say low volatility or quality as a factor of investing, and its correlation to an ESG score, if you have a sense of that, do you think it's worth studying whether a particular factor of say quality and the ES score, is that correlated and does that have bearing on stock returns and then risk? And my final question to you is, did you have any learnings and changes in the paper since you first presented? Because I saw your paper was presented at the Leeds conference also. Has there been any changes? Has there been learnings? And if you can share that with us. From my side, the way I see this has significant implications, and this is why I love this paper. The way an ESG fund is marketed, mostly is about return, right? That support good companies and your returns will be better. As this paper shows, that's not true. You can support any company and the risk return is the returns are fairly similar, but of course the downside risk matters. So in terms of how, as an asset manager, how do we position a ESG fund is going to be very, very significant. What is the main motive? Is it returns and risk, or is it peace of mind? Like I am as a manager, I'm choosing companies which have very high ES and G scores, and I'm fairly comfortable that my return and risk process over a period of time will be stable or will be healthy because I'm choosing good companies. ESG will also, a good score ESG, high and low, will also open up to a lot of long short strategies. Just as you have in quality and momentum, I think just using ESG as a score could have a long shot. Although I think in their paper, they do mention that if you short the low ES, doesn't have any major return implication. It might have some risk implication, but not return. Can you take ESG scores as a standalone approach? And this is what we've been doing at Quantum, where we've built our own proprietary internal scoring, and we only use our ESG scores to build a portfolio. Of course, we have portfolio construction guardrails. We have some financial parameters like the that the debt to equity and return ratios. But we've just taken ESG scores and no other factor, just ESG scores internal, and maybe there are already products on it. So if you look at the MSCI ESG index, there are passive indices based on it, right? So they're already built in. But the problem we have with external indices is that it's a desk job. So the MSCI team is effectively a scoring based out of data that comes about and has some checks. Standardization. A recent Bloomberg article, I don't know whether you saw it, uh, spoke about how the MSCI rating is ESG rating, essentially a rating for a company. So what climate risk is the company? It doesn't take into consideration what climate risk is the company causing to the environment. So it's very inward looking as well as against outward looking. And I think this will change. I mean, if you look at the Indian MSCI ESG Leaders Index, Reliance Industries has a 20+% weightage, one stock, one company, right? And we have a very different governance view on that company. So these are very evolving. I mean, and also it's investment banking, right? So there is a lot of already. I think there's already a lot of investment banking and that kind of stuff already in ESG and ESG ratings, and regulators will have to wake up to figure out that not everybody who claims to be a signatory to a PRI or a TCFD or investing through ESG is actually following any of those ESG parameters. So these are my closing comments. Thank you.
Thanks a lot, Arvind. You're certainly in the running, according to me.
Okay.
But it's a poll, so we'll figure it out. John, floor is back to you. Would you like to take a shot at responding to some of Arvind's questions? Should we keep the slide up for you to focus on? How would you like to do this?
Susan, can a couple of audience folks add a couple of questions so that John can respond to them together?
As John wishes. It's his session now.
I have a couple of questions and comments.
Yeah, yes. I guess I could take all the question and answer everything at the end if I could.
Good.
Okay. Should I ask the questions?
Yes, please.
Okay. So my struggle with the paper as currently presented is the rationale that you have for the companies with higher ESG scores having lower downside risk. So why is it that one should expect that to be the case? Now, if I think about it, I would say that maybe the companies which people expect that as time goes on, there would be more and more focus on ESG, and therefore companies would be expected to implement that anyway. And the companies which have high ESG scores today have preempted that in some form, and therefore they can have lower downside risk. That is my one thought that can explain it. Now, in that context, perhaps a more direct test for you to consider is to look at individual companies and look at the times at which they have implemented major ESG related activities which have raised their score substantially, an echelon difference in their scores, and then see what happens to downside risk to those companies, all things being equal relative to their controlled sample of companies. That would be a direct test. To my mind, the fact that you use only very large companies in some sense biases the results in your favor, because those companies which are large companies are the companies where the market would expect ESG factors to be more required, if you like, by activist investors, by other institutional investors, and therefore those are the places where you can expect a downside risk. And I'm also, Arvind brought up this point that, different host of ESG scores in the market. And you use just one of these scores. Yes, okay, albeit you use a very standard ESG score by MSCI. But at the same time, most people I've heard from the industry give me the same comment which Arvind gave, which was that they use their own ESG factors. Why? Because ESG is very subjective and they prefer to use their own. So how do I know that this is not really specific? Because rationally speaking, it doesn't make sense otherwise for ESG to have lower downside risk. I'll shut up there.
Thank you. Kose, do you? Oh, I think you're muted.
My question is actually related to Pradeep's question, but not the same question. So my first part of the question was exactly what Pradeep said. That is, if you go and ask based on the asset pricing theories, I want to see how it's related to the risk measures. So if you want to go beyond the market risk, systematic risk factor, there are other candidates for the risk factor, systematic risk, and you should use them because this downside risk measure that you computed, it's not clear exactly what it is. Mm-hmm. That's one. Second, in one of your slides, you did say that, yes, ESG might maybe help the firm to deal with future regulatory risk, maybe more effectively. But, that may not be captured though, any of your downside risk or anything like that. Why don't you try to model that factor? That is, firms which develop a reputation for ESG, they might be able to reduce the losses from future regulation in a better way. But that you just mentioned as a slide story. But you should try to kind of take that seriously and try to model it. So those would be my comments. So in other words, I don't know quite what to make of your result, actually. Even though you like to say, you gave it a nice name, so downside risk seems like something we should avoid. But you see what I'm saying? That's not quite science. That is more psychology, That's my view. Yeah. Thanks.
Hi. I have a follow-up question, actually two. While we're talking of ESG, I think if I just specifically focus on climate, if we focus on industries and within industries, company which are specifically affected by transition risk and physical risk, and if we create a tag or a dummy for those, would my results change? Because I can have ESG in a sector, say I'm just making this up, pharmaceutical, which need not be having a huge risk in terms of climate transition or physical risk, as opposed to something like anything in energy. So that may be a factor. Second, if I'm looking at downside risk, stock market is one, but that goes under all the wonderful assumptions of the market being, all those nice things. But I would also like to track in any downside risk the bond prices and the volatility of bond prices and the credit spread, because that may be an equal, if not more potent measure of downside risk than stock. So is there a plan to use credit spread or something from credit risk? Because a lot of the factors that goes into ESG rating, there's an overlap with credit rating, at least rating agencies claim so. Thanks. Those would be my two questions. Thank you.
So, sorry, I just wanted to interject. I think that with the focus on online, we do not have space for people to ask questions from the floor. So if anyone has questions, please do stick up your hand. Okay, Rajat.
So I just have a follow-up on the previous question. So in your methodology of constructing the ES index, right, which you consider 6 categories, maybe it's worthwhile looking at the cross-section of firms that you look at and weigh the different categories differently to compute ES square differently for each firm, right? So as was mentioned that an energy firm might have a different weighing for an environment factor versus a pharmaceutical company, maybe that will help you create a better index and maybe explain the results better. Thank you.
So should I try to answer the question so far, or?
Why not?
Yes, Kim, go
If I
ahead.
could just add to Deep's question, which is to because you look at the larger companies, then arguably they're likely to face a lower cost of capital. They may also be better at hedging and being able to hedge some of their exposures that they're facing. So I think I like Deep's point on two factors. Firstly, distinguishing between the transitional companies that will be affected versus those that may be affected less, and within them, larger companies that are just better able to hedge their risk. And to what extent, therefore, when you're looking at cost of capital, how that's reflecting some of how these companies are able to better absorb the risks that they're facing vis-a-vis climate change. So I think that there's some kind of probing that would be helpful here, arising from the fact that you're looking at bigger companies, which is not clear which ones will be affected and which ones will not. Certain of them will be better able to hedge it, and I think it'll be useful to see the results with those kind of nuances incorporated.
Who is Deep?
That's me. I'm online. Deep Mukherjee.
Okay.
Okay, so thank you so much for all the comments. I'm gonna try to get through all of them. The one I want to begin with was about the rationale for lower downside risk that I think Kose and Pradeep brought up. I think the main idea here is some notion of customer capital, basically. So there is a paper by Albuquerque and his co-authors, an MS paper, where they build a model where basically ES score works as like a kind of a product differentiation technology. And this basically makes their demands relatively more idiosyncratic, or it becomes less susceptible to variations in the aggregate market demand for a company. So in their paper, they actually build a theoretical model showing that high ES scores should be related to lower systematic risk. We did think about trying to build a extension of their model in such a way that it leads to lower systematic downside risk. But we thought the marginal contribution would be relatively small, and generally the way it should proceed to create that result was relatively straightforward, we felt. But this is certainly something we could think about for sure. Looking at we are not planning on looking at bond or credit spread right now. We wanted to focus primarily on the stock market because this is where a lot of retail flows into ESG investing has really occurred in the recent times. And we felt like it's natural to focus on the stock market and try to see, consistent with these regulations that are going on, what might be the consequences that occur to the average investors who are going into this kind of investing strategy, and to try to argue that it seems like at the very least you're not losing out, and if anything you're getting like a very mild insurance against the market declines. Another thing that this idea of I think Pradeep also brought up as well as Arvind about why only look at KLD. There is certainly a lot of data issues. In the paper, we try to argue that assuming these measurement errors that KLD might suffer from is an entirely vanilla classical measurement error type, it's very unlikely controlling for other types of ESG ratings as well is going to overturn what we find. And in the paper, we also look at sustained analytics data and try to repeat all the analysis that we've done so far with KLD measures. And we find results that are quite similar. But this is something people have been pushing. We are trying to get additional data sources for ESG. So yeah, and another problem, one of the restrictions of KLD is there has been some criticism that KLD is very good for having long history, but around 2010 or between 2010 and 2013, MSCI start to shift away from KLD measures to what they consider as, I think, IVA measures. So they merged basically two companies that were independently rating ESG performance, and they decided to shift over to this other company. So we've been trying to get that data to kind of extend the data forward. So there's a lot of data issues we are aware, but overall we try to do with what we have, and generally we believe that the results are reasonably robust. So that's my take for the data issues that we have as it is. But yeah, so thank you very much.
Kim, I have on my question on that governance. Yeah, why did you choose to leave it? I saw your results of governance not being significant, but on your overall series.
So with the governance, so again, this is something that's very specific to KLD database. So the reason why we focus on the E and the S components in KLD is following the prior literature, which tends to leave out corporate governance. Part of the reason is for quite a long period of time, what exactly the corporate governance category meant for the KLD database was very opaque. So we are not even 100% sure if that is a reasonable measure of corporate governance proxy. So it's more of a data issue that exists with KLD's G category more than not finding much of a relation between true corporate governance of a firm and the downside risks. Thank you for reminding me.
Okay, thank you.
I have a quick comment to make. It's related to Yesha's comment. When you think of this issue that you're analyzing, which I think is an important issue, you could either deal with the cost of capital, which is the denominator, or you can directly think of ESG versus regulatory effects on the cash flow of the firm. In other words, whenever you think about a project, you can say, there is bound to be, invasive regulation, and that will reduce the cash flows from the project. So what would be a positive NPV project may or may not be once you take this into account. And then what is the offsetting factors that ESG kind of things would bring? In other words, focus the analysis on the numerator, So that would be a way to. There are two ways of thinking about these issues. So that's all. Right? But thank you.
Yeah, we'll definitely try to look at the separation of the cost of capital versus the cash flows.
Yeah.
Yes. Thank you very much.
Thanks, everyone.